Hey everybody, good to be here. My name is Brent Moores. It is managing an options portfolio time. It is Wednesday, and let's get it started. Hey, we're going to go through some different positions today. I'm joined alongside Connie Hill in the chat, who's helping me out, and I appreciate her, of course. And you can follow Connie or myself on X at Brent Moore's CS, at Connie Hill CS. I've been working with Connie for over 2 decades now. So she has some wonderful classes out there. Make sure you follow her on X and check out her webcast as well. Now, before we get too far into this, let me just mention this. We're going to be talking, I'll tell you what we're going to be talking about after this real quick. Options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The material today that is intended for educational and informational purposes only. We'll look at individual stocks today and options. Those are not going to be recommendations. They're just examples. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including risk, loss of principal. Past performance is no guarantee of future results. All right, let's head on over. Here's a Thinkorswim desktop software. I want to talk about earnings today. We've been in earnings season. Earnings season is still going. We still have some big companies coming out with earnings. We've got, for example, Microsoft. Okay, that is today. We've got Amazon. That is today after market close here. Not tomorrow, excuse me, tomorrow. Amazon's tomorrow. Apple, for example, is tomorrow. And so what do you do when you have a company in your portfolio that has earnings? Well, Apple's a good example because when we look at Apple, we actually have a position on Apple in our portfolio. If I go over here to my long stock, we got Apple right here. All right, and so I can see, hey, I've got earnings 1 day till earnings on Apple. KHC, 5 days till earnings. By the way, this is kind of a little handy script there if you want it. I have it in the description of the webcast. I'll also put it in the chat for those of you who are watching live. Just remember, scripts are not guaranteed for accuracy or timing, but if you find it beneficial, if it's something you want to use, I've been given a lot of scripts in my life. You got to pick and choose which ones are valuable to you. And so I find this one, I use this one a fair amount. If you have the script, all you need to do is copy it, and then you can go up to the gear in the upper right portion of the page, click on Open Shared Item, paste that script in there, preview. You may be able to name it, I think, there, and then click Import. And then it will be there with your other column scripts. And so if you ever want to adjust the columns that are showing, click on the gear, and it'll give you, here's your columns that show, here's all the possibilities. This is where the imported script would be, by the way. Okay? So hopefully I realize I went through that a little quickly. I know a lot of you have seen that before. A lot of you probably already have the script if you want, and so there you go. But if you're all watching on a recording, that is in the description of the webcast. Days until earnings, Apple, KHC. If you want, you can go to the Market Watch tab, go to Calendar, and then just check earnings. If you have everything checked, it can be kind of cluttered, to be honest. If you check earnings, and then you can look and see what companies are coming out with earnings. Today is the 29th, and you can see that listed. And if you're looking for a particular company that you own or of interest to you, you can always put that up here, like McDonald's. Pull up McDonald's, it'll just bring up McDonald's, and I can see that right there. Okay, fair enough. Let's move forward. What happens on earnings? Well, when earnings comes out, let's look at a company that's already had earnings. This is a pretty typical scenario. It's not a guarantee for every time, but pretty typically when earnings comes out, and you can see that right here and right here and right here, you see a drop in implied volatility. You can see that right here and right there and right there. Not every stock fits the script, so to speak. But the expectation is generally when earnings comes out, you're going to see a drop of implied volatility. If you'd like, you can also see that, by the way, if you go to the Analyze tab, click on Earnings here, and here's Alphabet, and you can see this. Here's your implied volatility, which is in red, and it's cut off because of the way I have it displayed, but the historical volatility is in yellow. But you can see here's earnings. This is going back to fiscal quarter 2 of 24. That IV dropped. See that? Historically, it dropped. It dropped. It dropped. You see that? Dropping. When earnings comes out, typically that's going to happen. Okay, we already mentioned that. What does historical volatility do? Notice it goes up when earnings comes out. Typically, it may not. This one didn't really go up that much there, or it actually went down a little bit there. But in general, you're probably going to see an increase in the historical volatility. Keep in mind, those are telling you different things. Implied volatility tells you the market's expectation of what the volatility is going to be going forward. It's forward looking. So if you have an earnings event, which is this big news thing, the big uncertain thing that can move the stock way up or way down, we don't know, but the expectation is big movement. That's why implied volatilities are high before earnings, and then after the uncertainty comes out, at least a good part of the uncertainty comes out, then the expectation for future movement is diminished at that point. Okay, so that's what we see there. Historical volatility, on the other hand, that's what we're seeing with the yellow line here, okay, is a measure of actual volatility in the stock that's occurred. Well, before earnings, stock's not moving as much probably. After earnings, the stock moves more. So that's why you see the historical volatility go up in that time frame. So the expectation is when you have a stock and it's coming out with earnings, we don't know whether it's going to go up or down, but we expect it to move a fair amount. How can we get an idea of how much the market expects? Well, if you go to the trade tab, let's go to Apple here for a sec, because that's yet to come out, AAPL, that's coming out tomorrow night. Here's Apple. This is a position we have. How much is this going to move? Well, I don't know how much it's going to move, but one thing we can do is we can look here and see what the expectation is. Find an earnings date past, find an expiration date past the earnings date. This was today, so that's not going to count because that's not past the expiration date. Look here, look over here, and you can see plus or minus roughly 13 bucks. That's what the market is expecting for the earnings there. That's what's pricing in for the earnings. Roughly 68% chance, one standard deviation of that move. Now, sometimes you'll see like a market maker move on listed. It's a little yellow sign up here, which is just kind of another way of doing what I just did. It's not listed here because my front expiration IVs are lower than my next one, so we don't see that. But you notice what happens with implied volatilities. The one after earnings, typically that's the highest, then it goes less significant impact as you go out farther in time there. Okay, but just to be clear, this is showing the IV, average IV implied volatility percent. This is showing the expected move that this implied volatility implies in the stock. Okay, so I'm hoping that is helpful there. But then it begs the question, what should we do with our stocks before earnings? Well, if we look at Apple, here's Apple, here's earnings. We're going to expect that IV to drop. We're going to expect probably a bigger movement. One thing I can do is I can do nothing. I could just say, hey, we're in this stock, and you can look at your portfolio and look at your stocks and decide for your stocks in your portfolio, if maybe you're bullish long term. There may be some little bumps in the road with earnings that go your way or not, because we don't know what we're going to do. But in the long run, I'm bullish, and therefore I'm willing to, take part of the volatility there on that. So that's one thing you can do. Another thing you could do is you could take your stock and say, hey, we've been doing pretty well on this. I don't want to deal with this stock. I'm just going to sell out my stock before earnings. Okay, so we could just sell Apple. We got a nice run on Apple. I'm just going to sell out. That's certainly a possibility there. Another thing using options, and that's kind of what we do in this webcast, is we do options, is we could do what is called a protective put. Okay, protective put. And that means we'd be buying a put option, probably out of the money, say, I don't know, 320 or so. We'll look. And we could buy a put, so LP, long put, there. And that way, if the stock goes down a lot, the put is going to go up in value, and it's going to help offset the loss in the stock. There's temporary loss in the stock. We're not going to get rid of the stock. This is just meant to hedge temporarily if the stock drops. If I'm still bullish on this, okay, then that would be a consideration. This keeps me in the stock. It also gives me upside. If the stock, let's say the stock has a blockbuster earnings. Well, I'm going to lose some money on the long put, but if the stock goes up enough, it's possible I'll more than make up for that. Of course, you need to choose what put strike you do. If I go to Apple, look here, and I'm going to we'll go past earnings. Okay, so if I just go past earnings, this is Friday expiration right here. I could go out, and what price? I forgot what price we said. We said about 320. Okay, if I go to 320, my delta is about 10 there, relatively cheap. Initially, that's not going to offer me much protection here on this, but what it does do is the delta will go up if the stock goes down enough. Okay, if the stock moves down a lot, if the stock moves down $1, this is telling us, what the delta is telling us is telling us this is going to go up by about 10 cents. Okay, and 10 cents may not sound like much, but hey, look, we're starting off with a cheap option going from 80 to 90 cents. But as it drops more and more and more, the delta is going to go up and up and up, at least the absolute value of that delta. And it's going to offer more and more protection the more it drops. If the stock were to drop down from 340 to 320, we'd expect our delta to be about 50. Okay, typically at the money deltas are around 50. So it gives you more protection the more it drops. By going out of the money a ways, then what it's doing is it's saying it's going to be cheaper up front. Now we can get more protection here. We can go to, say, a 332.50 put. More protection, 28 cents on the first dollar move, and then it quickly will go up if the stock were to go up more. But it's going to cost you more, right? And that's one of the challenges on protective puts, is it does cost you money. And if the stock doesn't go down, if the stock goes up, you could easily lose it all, the whole premium. If the stock goes sideways, we're going to lose most of that probably, because this is out of the money. Only if the stock goes down a lot does this retain much value on that. So one other possibility is you could say, well, in addition to the protective put, remember, with the protective put, we have, first of all, negative theta. time decay is working against us. We have something that's going to lose money. Well, first of all, it's going to cost us money. So I'm going to put cost, okay? And it's going to lose if stock goes sideways. Okay? If stock goes sideways or up. Okay. The other thing we could do is we could say, well, what if we couple this with a short call, a covered call? So let me do short call. And these two together make what's called a collar. Okay. Have you ever heard of a collar? That's what we call a collar. A short call is going to have positive theta. So it's going to offset the time decay, the detrimental time decay of the protective put, at least to a large extent, maybe not 100%, but there's a good chance it will. It's going to bring in a premium. So it's going to offset the cost. Okay. Offsets the negative theta. It offsets the cost. And if the stock goes sideways, it's actually going to benefit us. But it's also going to limit our gains if we do that short, that collar here. So let's do this. Here's what I'm going to do. I'm going to do roughly a 30 delta on both sides on this. I'm going to sell. We'll go to the 29 delta. That's close. I'm going to buy the put, the protective put on this. And now what I'm going to do is I'm going to go to my call. Again, I'm going to go to roughly the 30 delta. I've got a 28 delta here. I'm going to sell this. I'm going to hold down my control key. When I put this all together, it's going to cost me a little bit, 35 bucks there. But if we analyze this trade and we look at this trade here, this is what it looks like. Let me just move this up just a little bit. Shrink this down here. Okay, here's the put, and this is showing us with the long stock. Okay, this includes our stock here. What does it do? It limits our upside. Bummer. It does limit the upside, but it limits the downside, just like that put. But at the same time, if we look at it, it cuts down our theta substantially. So for example, let me just put these as individual. It's not going to let me do that, is it? Let me just see. If I just did the long put, excuse me, this is not, there's something wrong with this here. This is not giving me the correct calculation. Should be a short, oh, I did the wrong thing. Let me get rid of the long put. No, I wanted to get rid of that. Why is that going to 0 on my Greeks? Oh, because it's not checked. That's why. No, it's still not showing. I don't know why. It should be showing a theta right now. A put would have a negative theta working against us. This is going to even out the theta to, if not 0, it'll minimize it significantly. Okay, so that's a collar. That's what we got with the collar. Let me go back and just put this trade on as it was. It limits our upside, it limits our downside. In this case, because of the expiration I chose, it's just for earnings. It's not a perfect solution, okay? A perfect solution would be something that would limit the downside but doesn't limit the upside. I don't have that for you, okay? But in this case, it's something, if you want to try and protect yourself before an earnings event, you can do a collar. This is an example of a collar. So I'm going to confirm and send this. I'm then going to look here and I'm going to put this in my long stock. And we've just collared our Apple stock before earnings. Now we'll see what Apple does. It may work for us or it may work against us. And it's not something I'm recommending you doing. I don't make any recommendations as to what you should do in this class. Furthermore, it's not something that's typically done before every earnings because ultimately, hey, earnings is just as likely to go for us as against us. It's just if we're worried about a particular stock, especially if we've had a nice gain, a lot of traders will consider doing a collar. Okay? I hope that makes sense there. Now, I have another stock and that's coming out with earnings, KHC. Okay. And you can see it's had a nice run. This earnings is, I think, next week. But we've had a nice run. We could take our money. The same choices exist. We could do nothing. We could just sell the stock if we want to take our money and get out of there. We could do a collar like we did before. Or if we want to give ourselves the potential for more upside and not cut out the upside, we could just do a protective put. And for the protective put here, I got to go out past expiration. So I'll go out 9 days here. And by the way, you can often tell when the earnings is because when there's an earnings, I said past expiration, I meant past earnings. When there's an earnings, that implied volatility jumps up. So we went up from 36 to 44. That tells me earnings does not occur before this expiration, but it does occur before this expiration. But when I'm going to look for those puts, very often we're trying to balance how much it's going to cost to the amount of protection you're going to get. If you go to these higher deltas here, you'll get more protection, but it's going to cost you a lot more. Okay. If you go to lower deltas, then it's going to cost you less, but initially it's not going to give you as much protection. As I mentioned before, the protection will go up if the stock drops for you. But a kind of a medium area that a lot of traders will look for is something around a 30 delta. That's not an absolute recommendation. It's just a fairly common practice of going to about a 30 delta on your protective puts. So I'm going to do that here on this. I don't want you to get the impression that I'm putting a protective put or a collar on every earnings we have on stock, but I do want to demonstrate it today here. So I'm going to buy this put and just make sure if I have 100 shares of stock, I would do one put. On KHC, I have 200 shares of stock. So it may make sense to do 2 in that circumstance. 2 protective puts on there. I'm going to confirm and send. And I'm going to put this in my stock portfolio. There we go. That's using options to try and help manage your risk there. Now, there's one other kind of risk management thing that I should probably mention, and that is a stop loss. Well, let's say we say on KHC, I'm going to just keep the stock, that's fine, but I'm going to put a stop loss in at, I don't know, $27 or something like that, or $26. You can do that, but just keep in mind, stops don't guarantee we're going to get out at whatever price the stop is. Let's say we have a bad earnings and the stock drops down to $24 and we have a stop at 27. Are we going to get out at 27? No, we'd probably get out pretty close to the $24 level in that case because it turns to a market order in that place. Now, that's a stop, just as what we call a stop, or also known as a stop market. Okay, you have your stop price and the stop turns to a market order once the stop price is achieved. So in our example of a $27 stop, once we're below 27, it turns to a market and we sell at whatever price. Some people will instead say, I want to do a stop limit. And if I do a stop limit, then I'm going to specify 2 prices. The price that it's going to trigger at, the stop's going to trigger at 27, and then the least price I'm willing to sell it for. Let's say we make that 26, okay? Because in that case, I don't want to sell it if it goes down to 24. Well, that's fine, but if it does go down to 24, you're still going to be holding the stock, okay? Because unless the stock goes up. Because you're saying I'm not willing to sell it for less than $26. So there's pros and cons on all of these. This is just a different attempt at trying to protect your portfolio, but it has some shortcomings definitely and some pros. It doesn't cost us anything as compared to doing either the collar or the protective put. Okay, now, could I sell? Fred says, can I sell deep in the money calls? I can sell deep in the money calls, but there's pros and cons on everything, isn't there? Okay. So if we sell a deep in the, let's say we sell a call that's, I don't know, at 26 on this. Okay. Just as an example. Let's say we sell a call here on this. We sell a call. Keep in mind, first of all, that anytime we sell an option, whether it's a call or a put, in this case, the protective put, we're buying the put, so it's not really an issue. But if you're selling the call as a part of a collar, or if we're selling a call, do a short call that's in the money or whatever, you risk early assignment. Okay. So Fred, I'm going to get to your question in one sec, but Carol said, if you collar your trade, will your stock get called away if the stock goes through the short strike? That's a great question. I can't rule out the possibility that you'd get assigned early, number one. If you hold it to expiration and it's above the strike price, you can plan on getting called out of that, but you can always look to buy back the short call before expiration, okay? But there is the chance of early assignment, okay? The odds of early assignment would increase the more in the money it goes, okay? So if we do a short call that's deep in the money, the odds of early assignment would go up. It's not a given, it's not a guarantee, but the odds of early assignment go up. If, as we get closer to expiration, and in this case, we're talking about pretty close to expiration because our expiration date isn't very far away on these, and we're waiting for our earnings to come out, odds of early assignment go up as well. Okay, so the answer is, it can, Carol. Yeah, it can. You can get assigned. It's not a guarantee, though, but it is a possibility. Maybe that's a problem. Maybe it's not. Maybe you don't mind selling for the higher price in that case. Now, what if we do it in the money? Let's say we do a deep in the money short call before earnings. Well, you're going to have a nice big premium, probably. Okay. You have a nice big premium. But remember, you're agreeing to sell it at the lower price. In this example, I'm agreeing to sell it for 26 bucks. Let's say the stock goes up a bunch. Well, I'm agreeing to sell it for 26 bucks. Well, I brought in a nice premium, but I'm not participating in the move up in the stock in that case. So that's one difference between that short call in the money versus in the collar example. We actually did it out of the money so that we got to participate to a certain extent, at least, if the stock goes up a little bit, okay? Not past the strike price. But in this case, we're, in this case, the short call is really limiting any gains that we'd have. So basically, what I would say is, if you're looking to get out of this trade, you want to get out of the stock anyway, you're looking to sell it anyway, and maybe bring in a little bit extra money in there, you can do so. You can sell that short call in the money. However, keep in mind this. Don't just look at the premium and say, oh, I'm getting a nice big premium. Because you got to take the premium, but subtract out the difference between the current stock price and the strike price. You got to subtract out the intrinsic value from that premium, because you're going to be losing that in terms of the difference when you sell it. So that doesn't really give you any gains. You can gain on the extrinsic value of that. And there's also the danger that the stock goes way down. Let's say the stock goes down to 22 or something. That would be a huge move, but just for our examples here, then you're still going to hold the stock. The premium would help you out a lot in that case, but it'd be a loser at that point. So really, you'd only do that, the sell and deep in the money call at that point, only if you're really kind of want to sell the stock and trying to gain a little extra premium there on that. Okay. Let me know if that makes sense, if you have any further questions on that, because I want to move forward and go to some managing some of these positions that we have in our portfolio here. So what I'm going to do here is I'm going to go to up here and look at some past trades. Okay. We have AVGO. AVGO was the wheel strategy. We did this last week. Okay. Wheel strategy. In other words, we sold a put with the intention of either just collecting the premium and keeping it. If it stays above, great. If it goes in the money, then that's okay too, because we're going to buy the stock in that case. We'll put the stock. And then we'll look to sell a covered call. Okay. Well, the current price of the stock is $373. It's gone down. You can say today's not been a good day for the stock. It's still out of the money. Okay. And if I were just doing a short put and I were worried about this, then you may consider buying it back. But in this case, when we're doing the wheel strategy, our express intention is to be okay with it if we put the stock. Okay. So I'm going to sit on this even though we're showing a loss on this trade right now. That's okay, because we're willing to buy it, because the whole premise of the wheel strategy is longer term, or at least we'll say in the near term, we're neutral to bullish, and we're still holding support here. That's okay. So we're going to stick with that trade. Okay, let's move forward. CCL was another wheel strategy one. Now, there may be an exception to the rule of, what are the exceptions to the rule of getting out of this, buying back the short put on the wheel strategy? Well, let me give you two exceptions. One, if you just change your mind and you went from this stock is neutral to bullish to I'm just bearish on this, I think it's going to trend down and go a long ways, then you probably don't want to be in the trade, and it may be worth it to buy it back for you. Okay. Even if you're losing. On this one, we're not, but even if you were, that'd be one reason to get out. The other reason you may consider getting out early is, let's say you sold this put for $54 and we've made almost all we can make, and we still have 23 days to go on this. Let's say the put were, it were only showing 10 cents left on the trade. Okay, looking at the mark price. It does, and it shows 26 here, but it's not, but I'm just saying, if it showed 26, you've made most of what you can make on the put at that point. Maybe you sell another put. You buy this one back and sell another put. Try and take advantage of those 23 days of time decay to benefit you while you wait and you resume the wheel strategy. In this case, we've made about half of what we can make, but there's still a little meat on the bone, so to speak, for that time decay work on this. So we're not going to do anything with this one either, but I'm just saying that's an exception on that wheel strategy. You could possibly roll it or something if you wanted to, if you quickly make the money that you make. But generally, kind of the default position here, I guess, on the wheel strategy is the intention is to buy the stock if it goes down. And so we're going to not look to buy it back in that case. Okay, let's move forward. Let's talk about seeing Carvana here. Carvana. Here's Carvana. This is a jade lizard. Jade lizard. Like we do with iron condors, for example, we're going to manage the call spread separate from the put spread, or in this case, it's just a single put. We're going to look at these individually there. Okay. Well, let's look at the put. The put is basically break even right now. We're up just a smidge on that, but it's pretty close. We sold it up here for 375. Right now it's 367. Okay. Just going to let it sit. We're going to let the time decay work on this. And our theta still positive, 12 bucks a day on time decay on that. Okay. So we're going to manage these two sides separately. The put side, we're just going to let it sit here. What about the call side? Well, the call side, we're making a little money here. Okay. So it's the difference between these two values here, which would be what, 15 bucks. So not a ton of money, but it was actually looking a little better before when I was looking at it. But when do we get out? Well, one reason we would get out is, there's three reasons we'd get out. Okay. One, if we have a complete technical breakdown and we could just go, hey, this is a bear call spread, and I'm just completely bullish on this trade now. Probably get out. Number two, as we get near expiration, less than 10 days, we'd likely get out. Number three, if we've made most of what we can make on the trade. Well, what was our value here to start? Our value to start was the difference between our trade price. Okay, so that's 360, that's 46 cents. Okay, so we sold that spread for 46 cents. You see where I got the 46? I just subtracted 259 from 305, 46 cents. That if I've made basically 80% of what I can make, so if I could buy it back for like 9 cents maybe, that would be about 80%, then I'm going to look to get out. Now, some of you are going, Brent, are you a math whiz? You were able to do 80%, subtract 80% from this in your head real quick. Here's what I did. I just doubled the 46, okay? It gave me basically 90 cents, okay? 90 cents. And I moved the decimal point over, okay? 0.09, right? So, because if there's 20% left, if there's 20% left of this, then, 20% left of this, then that means I could buy it back. I've made 80% at that point, and I could buy it back. Well, are we to the 9 cent point? No, it's still worth 32 cents. It's gone from 46 to 32, which is great, but we're still going to stick with the trade. So I'm not going to touch the Carvana trade here. Okay. Any questions? Any follow-up on that? So if I ever have a short put or a short put vertical or short call vertical or whatever, and I say, let's say it starts with worth, I don't know, 50 cents. And my rule is I want to get out if I've made 80% on that. What I can do is I could take 80% of that and subtract that from 50, or I could just take 20% of this. What's 20% of 50? Well, 2 times 5 is 10 cents. That'd be 20%. You see that? Just multiply by 2, and that gives you what 20% left would be. All right. I don't want to beat the horse too much there. We'll leave it at that. Okay, let me just check time. Okay, we got time for a couple of quick ones maybe. Let's look at Nike. Here's Nike. What do we got here? Well, we got a short put vertical. We've got a short call vertical. That's an iron condor. So kind of case in point, we're going to do the same thing. We're going to manage these separately. If we have a complete technical breakdown on Nike, then that could either be a huge move up or a huge move down, and it looks like it's not going to go neutral anymore. We're just going to get out of the trade. Well, obviously it's not completely breaking down on this. We're down $2 on this one. We're up 40 bucks on this one. So the call side's doing well. The put side, not doing great, but it's not terrible either. So we're also going to get out as we get about to a week to go, less than 10 days till expiration. We don't have that either, but we're going to manage these separately. Put side, we're going to let sit because it's not doing great, but hey, we still have positive theta on it, okay? Difference between the thetas, that's going to give me the net theta on that. We still have positive theta on that. We're just going to let that run there for the put side. What about the call side? Well, have I made 80%? No, not quite. But look, this is about, we sold this for 37 cents up front. Right now, it's about 17 cents, okay? So we haven't made 80%. Now, if you go and say, well, I don't want to use 80%, I want to use 70%, fine. I'm not recommending you need to use 80%. It's just something that we've used in this class. And you can choose your number, but that's how you do the math on that number, okay? All right, let's go. We're going to look and we're going to go to another trade that we're currently managing here. Let's look at let's look at CSX for a sec. What do we got in CSX? CSX, kind of a weird, is this a spread? What is this? Kind of a weird trade, right? This is a synthetic, okay? We bought the call, we sold the put, same strike, same expiration, that's a synthetic, long synthetic. So this is a bullish trade. For the most part, we're going to kind of manage it as if we owned the stock, because this is synthetic of the stock. We're trying to mimic the stock. It's not owning the stock. We don't get dividends. There's an expiration date, okay? Those are a couple differences. But there we go, okay? So let's go and talk about managing this. What are we going to do? Well, let's look at the stock first of all. CSX. Okay, so it's going fairly well. It's pulled back a little bit. We have a stop on this. Okay. Let's just make sure the stop makes sense. Exit below 44.50 because it's been doing well. I don't want to give, if it totally reverses itself, I don't want to give that all up. 44.50. So that's about here. You know what I would say is I think we could probably move that stop up at that point. Okay. We could move this stop up. What I'm going to do is I'm going to say this. Now, one thing I can do is you can always use like moving averages. You can say, well, look, we're looking for a bounce here, but I'll give it to the 50. This is a 50-day moving average in blue. This is a 20-day. This is the one we're looking at for support. If we break it, once we cut below here, I'm probably out of this. I'm going to say 47.50. So what I'm going to do here is I'm going to adjust this. If I look here, CSX, there's CSX, okay? I'm going to right click on it. I'm going to cancel and replace this. And we're going to move the stop to 47.50. Okay, it's just a coincidence. It's the same strike, same price as the strike price. It has nothing to do with each other. I'm going to click on the gear. Let me move this over so you can see it. One sec. Our current stop, or exit, I should say, is at 44.50. Not guaranteed, right? It doesn't mean we're going to necessarily get out right when it's there. What if the gap's down, right? But we're going to change this to 47.50. I just did a cancel and replace. Save that, confirm and send that. And now, when I look at this, I just got to change my little note here. 47.50. We're trying to protect profits on that. That's our goal here on this one, is to protect profits. All right, I'm out of time, folks. I appreciate you. Okay? I appreciate you for joining me today. And we talked about kind of some choices you have before earnings. It's not a recommendation of exactly one thing to do, what to do. Remember, you can do nothing before earnings. Very common. You could sell your stock before earnings. Less common probably, but it's a possibility. You could buy a protective put. You could do a collar, right? Those are all choices we talked about. And then we talked about some management of these positions. Thank you all for joining us. Thank you, Connie, for helping me out in the chat, of course, as always. Coming up next, we have trading price patterns. Check that out. Also, make sure you subscribe to the Trader Talks channel. Doesn't cost you anything. It gives you the content that I think you'll like. And if you like the session, I do appreciate the thumbs up at the bottom of the page. It benefits me. I appreciate you. It benefits the channel. It benefits the cause of free education, I believe. So thank you all. Have a wonderful rest of your day, everybody. And we'll see you all same time next week. Bye-bye, everybody.